It's hard to believe that autumn is officially here. And you know what that means. The air gets crisper, the leaves start to turn brown, and it's apple picking season. With Apple stock recently pulling back, is it now ripe for the picking? Well, we're going to bite into the stock as well as pick a trade or two with triple-digit return potential. All that with a small move in the stock. So grab your wheelbarrow and let's get picking. Hey, Optionetics Power Profit Trade members, welcome to Tom's Trading Room, where we offer analysis, insight, and step-by-step comparisons of alternative investments other than just buying stocks. Do me a favor right now below the apple and hit that like button as it helps support the channel. Also, if you click on the subscribe button and ding that bell next to it, we'll notify you as soon as a new video is uploaded. Okay, now I want to talk about Apple, the stock, not Apple the fruit. And we're going to look at some charts potentially showing buying opportunities and how to make a 250% reward to risk trade without coming close to Apple's all-time high. So let's jump back into my podcasting room and check it all out. All right, let's not waste any time and get straight to Apple. I've got several charts I want to show you, and we're also going to dive into some option strategies. I'll be using our software at tomsoptiontools.com. If you want a free trial and you're brand new to us, down below this video there is a link to a 2-week free trial on everything that we offer here at Tom's Option Tools, whether it's the option trader, the contrarian trader, which has our own contrarian signals, and complete trader, which includes the money calendar, which I'll be touching on a bit in this video as well. All right, first chart we got here. This is a chart of Apple. You can see back in May, $75. Back just last month or earlier in September, almost $135 before pulling back to the 105 area that you see us hopping around as of recent. Now, we got earnings coming out in 35 days, and the other thing I want to mention is this red line here. This red line is options volatility. And you can see here that option volatility was low, but it's much, much higher. It was much higher back earlier this month. It's come back down, but still expensive. And I expect it's going to stay expensive over the next month. We'll talk about options premium in a few minutes, but I want to show you some other charts. So number one, we're seeing technicals, and we're seeing what's called stock chart peaks right above the 105 level. All right. Next, check out the Fibonacci levels. Now, I did a video recently on Fibonacci. You can find it right here on the YouTube channel. But to save some time, what I'm going to talk about is the low that occurred back in March, 56.09 for Apple. The high that occurred earlier this month, 134.18. We have a 38% pullback. That's from low to high. The pullback percentage, 38%, 104.35. 50%, 95.14. 61.8%, 85.92. We have come very close. We hit the 38.2% retracement earlier this week. We also hit it just recently a couple of times. We're bouncing off that 104.35 number. Now, there's two things going on here. Number one, we've got, look at our stock chart peaks again, around 106, 105, 106. Auto Fibonacci's. And this is an auto fib tool that we use for those of you that are on Tom's Option Tools. If you go to stocks and you go to charts, you can come right down to auto fibs. It'll open this up. I have the plot days on Apple, if you're following along with me, at 150 and the peaks at 150. That just basically says go back 150 days, give me the low, give me the high, and auto snap this thing so we can see Fibonacci's right on the fly. All right, so we know that there's a lot of significant support around the 104 to 106 area because of Fibonacci and our stock chart peaks. Now, let's look at another chart. This is going to be different. All right, this chart I want to show you is probability cones. Probability cones give us a mathematical, statistical probability that Apple, in this case, as you can see right here, is going to stay within these certain cones. The red cone you see here gives us a 68% statistical probability that Apple is going to stay inside this particular cone. Notice the cone gets bigger the farther you go out. That's because the more time you give Apple, the more time it might move up or down. The blue cone is a 95% statistical probability we're going to stay in between this cone as Apple moves out in time. Now, I snapped this not today, but I snapped it on Apple's high. All right, because I wanted to see where it was going to go after it hit the high. And on the day that it hit its all-time high, we see the cone moving up and we see the cone moving down. Now, look what's happened since then. Apple dropped and hugged the blue cone. Then it moved sideways and it got inside the red cone where it currently is right now. So it is staying within the walls of the statistical probability, or what we call standard deviation. Now, what this is telling me is that it's on the bottom end of this cone. There's no reason why it won't shift and head toward the middle of the cone and maybe even higher as we go into the next earnings report for Apple. All right, finally, let's go to the future. This is the money calendar. Now, what I did here is I can go in and I can look at the money calendar as a whole. Look at the months. We'll do it right now. So you can see here the last week of September and into October. The money calendar overall says green. But what if I just want to look at a particular stock? Well, if you come up here and you come across and you'll see something that says money calendar app, let's click on that and let's put in AAPL. Now, doing nothing else, just click on show. Immediately it tells us there's a lot of green in Apple's future based on its past. Now, it's no guarantee. All right, nothing's 100%. But if we take this data, we can see that, 6 of the last 7 years, Apple has moved higher during the month of October. This is all good information that we can utilize. Now, I could slide these around a little bit and say, all right, let's take a look at the next 10 days, and let's look at the last 10 years. I'll go ahead and show again. And now what's happened is it's showing us that 7 of the last 10 years, it's gone higher as well. So we have technical charts that are showing support. We have Fibonacci levels that are showing support. We have a probability cone that's saying we're staying inside the cones on the bottom side, and we have a money calendar that tells us 7 of the last 10 years, and more importantly, 6 of the last 7 years. Apple has moved higher in the month of October. All right, we've done enough work on the asset. Let's move to the options. Remember I said the options are a little bit expensive. This option volatility on the low side was trading around 25. On the high side was trading over 70. So if you pull this back, you can see that we're still slightly above the average volatility since May. We're going to take that information and we're going to look at a stock option table. Again, I'm doing this all in tomsoptiontools.com. Now, to get to the option tables, for those of you who are new, once you've logged in, you come over to options and just scroll down to option chains. That'll bring this up. Make sure you have Apple put in place, and you'll see all the expiration days. I want to go out to November 20th. All right, even though I'm seeing data that says the month of October is bullish, one thing that I know that the software doesn't automatically tell me is third Fridays have the most strikes, and more importantly, they have the most volume. That's where all the volume goes. So October 16th is the third Friday in October. Well, I really need to get past the 30th to really kind of satisfy all the work I just did. So let's go out and look at November 20th. You look at November 20th, and we come down, and once you click on search, you will see what I see. Calls on the left, puts on the right. Let's take a look at the calls real quick. So the stock is trading, as of this video, around $109 a share. The 110 calls from November going to cost me $840. $8.40, multiply it times 100, that's what the contract allows us, $840. All right, so if I'm looking for this to go to, let's say, 120 by November 20th, that $8.40 by November 20th might only be worth 10. So I'm risking $8.40 to make what, $1.60? No. The reason why these are so high is that you've got volatility high. We're moving into a tough month for the stock market, a volatile month for the stock market, election year or elections coming up real soon, and Apple's earnings to boot. That's why you're seeing volatility at its highs. Now, if you believe that Apple's going to get back up close to its high, maybe not its all-time high, now you definitely don't want to be buying the 130 calls for $2.32. That's a risky play. Why not sell this? Take in the 232 and use it to help you buy something that's lower. So let's say if we bought the 120s, we paid $458. We could take the 232 down here and apply it to the 458, and that'll drop our cost nearly in half. Absolutely in half. Let's go ahead and take a look at it. And what you do is once you've done that, you click on risk graph, and then that's going to bring up the risk graph like you see here. Here's the trade. Buying the November 20 120 calls, selling the November 130 calls. You can do that for right now $226. $226, not $458 for the call. If we get to 130 or above by November 20th, your $226 can max out to a profit of $774. Remember, the most that this can get is the width between the strikes. 130 minus 120 is 10. If you paid $226 for something that's worth 10, you take home $774. All right, but you have to stay in the trade the entire time to do so. One of the things I like to do is take half the trade off if it doubles in value. So if I'm buying it for $226, I'm going to sell it for twice that price, or sell half. In order to sell half, I might need to buy more than one spread. I would need a minimum of 2 to be able to sell 1 if it were double in value. Then hold the remainder and see if we can go for that big $774. Not a bad way to spend $2.26 for the spread, or $226 per contract. That's how you pick apples. Hey, thanks for watching. Check out all of our videos by subscribing now. You'll know when the next video is uploaded. Until then, we'll see you soon. Woo.